Kroger, stock ticker KR, is currently trading at $46.17. Over the last year, they are down 7.3%, and year to date, they are up 3.8%. If we zoom in at just the latest week, we can see they actually took quite a dip after reporting their earnings, which was quite a surprise since they actually beat on the bottom line, but missed the top line by a mere $70 million. So in this video, I want to take a close look at the intrinsic value of Kroger to see whether or not it could be a buy at the current levels. Because if we look here at the dividend stats, you can see that it boasts a dividend yield of 2.25%, a low payout ratio of just 24%, and a 5-year dividend growth rate of 15%, and actually has grown the dividend for 16 years. And as you can see here, continuous payment 16 years and growth of all of them, and it's nice up and to the right, this graph that we see down here. So if we jump into a stock screener and punch in KR and wait for everything to auto-populate, we'll quickly see that we have everything we really need here. So as mentioned, we do have a PE non-GAAP forward ratio around 10, which is a bit lower than the usual 5-year average, around 15% lower. Dividend yield 2.25%, as mentioned earlier, a very low payout ratio, and we are a little bit in between the 52-week low and the 52-week high. The analyst target price is $51, roughly 10% upside from here on. EPS growth of 23%, and then return on equity of 23% as well. Looking really good. If we jump into a dividend data tab here and zoom in just a little bit more, you can see here what I want to see is in the first table, I want to take a closer look at some continuity in the dividend growth. So I want to take a close look here to see whether or not it is grown steadily or if there are some major outliers. And as you can see here, the dividend growth rate over the last 10 years is around 13%, which is pretty much in line with a lot of the years. You can see 13, 13, 14, then a bit high here on 20%, but down again to 10.6. So it is looking pretty good and steady, and that's really what we want to take. And that is really what we want to see in this graph. Coming down here, we can also see the two dividend yield graphs. And according to dividend yield theory, whenever this graph on the right gets above the line into the blue area, that could indicate it being undervalued. And also, if we take a closer look over on the left here, it doesn't say anything, but if we go up here, it actually says the discount current yield versus the 5-year average is around 6%. And if we come down here to the bottom, you can actually see that Kroger has outperformed the S&P 500 over the last 10 years in a cumulative rate of return. So jumping into our first valuation model, which is the discounted cash flow model, we do take the free cash flow from the different years. We then apply a growth rate to project these future free cash flows from this. And then we do take a discount rate that'll discount the future free cash flow back to a present value. We then sum all this together, combine it with the cash and cash equivalent and the total debt from Kroger and the shares outstanding, we arrive at a fair value of $17.45. The next one is the dividend discount model, where we do take the dividend payout from the different years. We then use that to calculate a growth rate from the previous year. We can then average all these together to get an average growth rate, and applying that growth rate or something else, in this case I took 10% with the weighted average cost of capital, we can then arrive at an intrinsic value for Kroger. But since the weighted average cost of capital is lower than the growth rate, then this becomes a negative, and we will thus exclude it when we get to the summary later on. Next one is the multiples valuation, where we do take some companies that are peers to Kroger and then combining their PE multiples and their EPSs to get a hold of where this should be if it was similar to its competition. And based on that, we get a median PE of 18.45, which means that the stock price should be $56. The next one is the price to earnings valuation, where we do take the PE ratio from the different years. We then average all this together to get a 5-year average. We can then hold that up against the trailing 12 months of EPS to get an intrinsic value of $39.34. Next up is Graham's revised valuation model, where we do have the formula on the left here that we do want to fill out. So we do take the EPS from the company, the PE of a North growth company, the growth rate for Kroger projected for the next 5 years, average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. Combining all that together, we get an intrinsic value of $43.90. The next one is the free cash flow valuation, similar to the PE valuation, where we do take just the price to free cash flow ratio from the different years. We then average that together for the last 5 years to get a 5-year average. Combining out the free cash flow per share, we then arrive at an intrinsic value of $22.91. Next up is the Peter Lynch model, where we do take the growth rate, the dividend yield, and the PE ratio of Kroger. Combining all those together, we arrive at an intrinsic value of $46.35. If you want to make this model yourself, please take a look at my videos where you can find a complete walkthrough on how to do the Peter Lynch model. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please consider subscribing to the channel and like the video. Now let's jump into the summary. We do have all evaluation methods for Kroger, and as mentioned, I wanted to exclude the dividend discount, so let's get rid of that. We arrive at an average intrinsic value of $37.74, which is 22% higher than the current price. But if you take a closer look at the methods we do have, you can see here the discounted cash flow model is at $17 and the free cash flow is at $22. So all these models that has with the free cash flow, they are very, very low compared to others. So just for the fun of it, let's try to exclude those two just to see where we end up. And we actually end up being right on the money almost. A slight overvaluation with the current price basically. So taking this into account, it could indicate that Kroger is at a fair value right now, but let's try to put these back again. Then if you want to be on the safe side, and in these models, we do have some margin of safety built in as well. So I would say if it dips closer to this $40, maybe I would consider it a very sound investment if you believe in the long-term outlooks of Kroger. Thank you so much for watching, and I'll be seeing you in the next video.